Most of your net worth doesn't belong to you, not yet. It belongs to a system that allows you to access it most of the time. Right now, in a server room you've never seen, there's a number next to your name. That number represents years of work, discipline, and sacrifice. And the only thing standing between you and that number is a set of permissions you never consciously agreed to. So here's a question worth sitting with. If the digital grid went offline for a week, a regional bank failure, a cyber attack, a policy shift that arrived without announcement, what percentage of your wealth could you actually hold in your hands? 10%, 50. That question has a technical name, counterparty risk. And most people carry it every single day without realizing they've signed a lease, not a deed, on their own financial life. There's a version of financial security most people believe they have. They see the balance, the statements, the quarterly report. Everything looks solid, everything looks safe. But here's what that balance actually represents: a promise. Someone else's promise to deliver what's yours when you need it under conditions they set. And promises have fine print. You've probably heard the phrase, too big to fail. What fewer people discuss is what happened to the people who were technically protected and still waited months to access their own money. The wealth didn't disappear, the permission did. And for a moment, those two things were indistinguishable. If you've worked for years to build something real, you deserve more than a claim. You deserve the title. There's a framework for this. It's been used quietly by certain family offices and private wealth managers for decades. Not because it's complex, but because most financial institutions have no incentive to teach it. It's called the sovereign vault. Not a physical box, not a political statement, a strategic architecture of direct ownership where your wealth sits on ground that you control, titled to your name, reachable regardless of what any institution decides tomorrow. Over the next several minutes, you're going to understand the three pillars of this structure. And more importantly, a migration roadmap that makes it achievable starting with as little as 10% of your current liquid reserves. But first, you need to see the exact mechanism working against you right now, because it's invisible by design. There are two financial systems operating simultaneously in the world. The first is the permission system. This is where most people live. In this system, you have access to your wealth. But access and ownership are not the same thing. Your bank account, your brokerage position, even the gold inside certain ETFs, these are ledger entries. The physical reality of your claim lives on someone else's balance sheet. They can limit your withdrawals, they can freeze your account, they can fail, and your name moves to the creditor queue. The second is the sovereign system. Here, ownership is direct. The title is yours. Physical reality and legal reality align. If the institution vanishes overnight, your asset doesn't vanish with it. Most people have spent their entire financial lives in the first system. It has rarely created enough visible friction to question it, until the system decides to push back. The sovereign vault exists at the intersection of these two systems, and the goal is methodical migration, not panic. The first pillar is what professionals call direct title assets. These are assets where your name isn't on a digital ledger, it's on a legal document. Physically held precious metals, properly structured, real estate owned free and clear, with no debt instrument creating a third-party claim over it. Hard assets with weight, with serial numbers, with your signature on the paperwork. But here's where most people make a critical error when they first move in this direction. They buy gold, they assume they own it. And depending on how that gold is structured and stored, they may own nothing more than a promise denominated in gold. This distinction is called allocated versus unallocated, and it may be the most consequential two-word difference in hard asset protection. Allocated gold means you own specific identified bars or coins, serial numbers, your name, segregated storage. If the storage company ceased operating tomorrow, your gold doesn't become a creditor claim, it's yours in legal, physical fact. Unallocated gold means you own a claim against a pool. You are an unsecured creditor. The institution can and often does lend that gold out. You don't own gold, you own a promise of gold. During the 2008 financial crisis, clients holding allocated positions in professional vaults withdrew their bars without disruption. Unallocated account holders in the same facilities faced delays, restrictions, and in some cases, partial recovery. Same vault, different account type, completely different outcome. When evaluating any precious metals storage provider, ask three specific questions. Is my holding fully allocated and physically segregated? Can I receive a bar list with individual serial numbers? Are my assets legally off the provider's balance sheet? If they hesitate, you have your answer. The second pillar is self-custody, and it extends beyond the physical. Modern tools now allow individuals to hold certain forms of digital value with the same sovereignty as a gold bar in a private vault. The underlying principle is mathematical rather than institutional. In this model, ownership isn't a database entry that someone else administers. It's cryptographic proof that only you can present. This is what being your own bank actually looks like in the modern context. The mathematics of privacy works like this. When you hold value through an institution, that institution's financial health becomes your personal risk. When you hold value through self-custody, your only counterparty is mathematics, which carries no credit rating, accepts no bailouts, and doesn't close on federal holidays. This isn't speculation. It isn't aggressive investing. It's a form of insurance, specifically insurance against institutional failure, the risk that most financial conversations treat as hypothetical until it isn't. The sovereign vault framework doesn't distinguish between physical and digital. It distinguishes between assets where you hold direct title and assets where you hold someone else's promise. The tools for self-custody have matured considerably. The barrier to entry has dropped. The case for ignoring it as a complementary layer of a serious wealth protection strategy has weakened considerably. The third pillar is one most financial conversations never reach: jurisdictional diversification. Your assets exist inside legal jurisdictions. Jurisdictions have governments, court systems, monetary policies, and the occasional institutional emergency. Geographic concentration, keeping everything inside one country's financial and legal framework, is a form of silent risk that rarely appears on a balance sheet until it matters. This doesn't mean relocating. It means deliberately distributing the legal exposure of your assets across multiple environments with different risk profiles. Professional private vault storage in stable jurisdictions outside the domestic banking system. Legal structures that provide documented asset protection under different frameworks. The understanding that the global economy is not one system, and your net worth doesn't have to behave as though it is. This is jurisdictional diversification for wealth protection. It is not evasion, it is engineering. Now how you begins. The migration roadmap starts with a principle called the 10% rule. Most people feel overwhelmed by the concept of wealth sovereignty because they imagine restructuring everything at once. That's not what this requires. Start by moving 10% of your liquid reserves into sovereign structures. One carefully chosen allocated precious metals position with a reputable non-bank private vault. One step toward a self-custody solution for a portion of your digital holdings. One consultation with a qualified attorney about the legal frameworks available for asset protection in your personal situation. 10%. Research in behavioral finance shows consistently that the psychological benefit of holding even a small position in genuinely owned, untouchable assets is disproportionate to its size. When you know that a portion of your wealth is in a structure that cannot be frozen by an institutional failure, cannot be restricted by a policy shift, cannot be locked behind permissions, the financial anxiety surrounding the other 90% decreases measurably. You're not building a bunker, you're pouring a foundation, and a foundation doesn't need to be the entire house, it needs to hold. The sovereign vault isn't a product category, it isn't a single service. It's a way of thinking about ownership that most of us were never taught. We were taught to deposit, to delegate, to trust the institutions. Those institutions are largely trustworthy, until they're not. And the people who feel a system stress most sharply are those who had no structure outside it. No allocation, no private storage, no self-custody layer, no geographic distribution. What you're building with this framework is optionality. The right to make decisions about your wealth without asking for anyone's permission first. Sovereignty, in this context, isn't about isolation from the system. It's about having a floor that holds regardless of what the ceiling does. The 10% you protect today isn't just 10% of your portfolio. It's 100% of your peace of mind. The conversation about wealth protection rarely ends with what to own. It continues with how to pass it on, and whether the people who come after you will understand how to maintain what you built. The sovereign vault isn't just a personal framework, it's a generational one. The families who preserved wealth through financial crises and institutional collapses weren't necessarily the wealthiest. They were the most deliberate. They understood at a foundational level the difference between a balance and an asset, between a claim and a title, between temporary access and permanent ownership. That distinction is available to you now. The first step is smaller than you think. The peace of mind on the other side of it is larger than you expect. The grid will keep running until it doesn't. And when it pauses, even briefly, you'll want to be standing on ground that's yours.